All right, so in this video, we're going to talk about the big question that people usually have when they're getting started in multifamily is how does all the money come together? Like, how does that part work? So in the world of apartment investing, there's usually two buckets that we talk about when it comes to funding a deal: the primary bucket and the secondary bucket. The primary bucket is usually funded by some third party. It could be the seller, but it's probably going to be a bank, a credit union, a broker who helps you get bank financing. And that's typically going to cover anywhere between 60 to 75% of the purchase price. So it's the majority of the deal. The secondary bucket is the rest of the capital that's needed for the deal, which would be the down payment, closing costs, impounds, like reserves, if there's rehab, things like that, right? So there's two buckets. The first one, financing, I'm not going to talk about too much in this case, as it's not going to be as relevant for the rest of our conversation. But just know, if you ever have questions about the financing part of it, we have actually lots of videos that are available where I go deep into that side of it. But what I want to talk about with you today is helping you understand the secondary bucket, because that's probably where you're going to be involved in the real estate deal when it comes to your finances. So when it comes to the secondary bucket, there's two possibilities for a deal. And you might have heard of both these terms. You may have never heard these terms, might have heard of one or the other. So my goal here is to shed some light at a very high level about what those terms are, what do they mean? And then the next two videos, I'm going to go deeper into each of those, depending on where your interest lies. So the two terms that we use to describe the secondary financing is joint venture and syndication. So what's the difference? Well, one, joint venture is it's a structure that's usually a few people. Up to 5 people is common. So 3 to 5 people is a joint venture. In a joint venture, everybody's active in the deal. So the deal has to be small enough from a financial raise that all of the money for the deal can be raised by just a few people. So that's why you don't tend to see joint ventures as you get into larger and larger apartment buildings, because you usually need more people in order to fund it. But in a joint venture, everyone has to have some active role. So what's most common and what we, see in the academy, what we see in real life is there's a main person or maybe a partnership that brings the deal. So they're out there researching markets. They're, building relationships with brokers. They're getting deal flow coming in. They're analyzing the deals and they're making offers and they're doing due diligence and they're getting the financing and they're raising the capital, they're closing the deal, and then they're operating the deal, right? So those are like the main people of the deal. We'll call them the operating partners. But if the operating partners don't have all the capital needed for the deal, which is very common, especially if you're on deal number 2, 3, 4, or 5, and you start running out of your own capital, they're going to need other people to join the deal in order to finance the deal, or in order to fund the secondary bucket. The difference between JV and syndication is very important because the SEC, the Securities and Exchange Commission, is the one who governs all of that. And one of the things that they have defined is that in a joint venture, everybody has an active role. So we already talked about the operating partners, the one who's doing the majority of the deal, but all of the other partners in the deal need to have something to do. So it doesn't have to be a large role, but something that shows that you are actively involved in making the profit on the property. That could be taking the minutes for when you have partner meetings. It could be dealing with the CPA at the end of the year and getting all the bookkeeping and handling that. Like, there's a million small roles, but everybody needs to be actively involved and everybody has voting rights. Now, what the ownership percentages are, voting rights, all of that will be defined and outlined in the operating agreement of the LLC that is created for that deal and for that partnership, right? So that's joint venture. Everybody's active and it's usually a few people. On the other side, syndication is where you have some people active and some people are completely passive. So the active people would be kind of like the operating partners in a joint venture. They're the ones who are active and they are called the GP, or the general partnership. Everybody else in the deal who's just putting money up, they have no other role. Their role is to take their money, whether it's out of a self-directed IRA or self-directed 401k or out of their bank account, and put money into the deal in order to be able to get a return. Those are called LPs, or limited partners. So it's important. It's an important distinction because the SEC looks very strongly at that. And if someone says, oh, it's a joint venture, but all the people who put money in literally have no role, no voting rights, don't really know what's going on at all, they would say that's not really a joint venture, it's a syndication. And there's a pretty substantial difference between the two. And I will get more into it when I do the video on syndication. But just know for now, when you're hearing those two terms, that's what it means. Joint venture is going to be probably a smaller deal, a few people, everyone's active. Whereas syndication is going to be a deal where the fundraising part of it is a little bit higher, where you need more people, and you'll have both active and passive investors. So if you're watching these videos and you already know, I have no interest in being active, I'm just going to be a passive investor, then what you're likely to be focusing on is syndications and investing in syndications. So when we get to that part of the video, pay closer attention because that's going to be more relevant for you. And if you're like, I'm not really sure yet, I'm kind of on the fence, and maybe I want to have a little bit of an active role, then go ahead and watch the joint venture video as well, so that you kind of have the lay of the land, and maybe you end up doing both, which would be pretty cool. All right, we'll see you in the next video.